Last time you were here, Stephanie, stocks got hammered, and here we go again. Mike, Apple, manufacturing.
It's not nice to blame her for that.
They just kept coming. I just noticed a correlation, that's all.
Yes, not causation, but correlation. Look, I mean, this was a day for China macro panic. I think the stock market actually made a good run to the middle of the day to try and separate the vulnerable from the strong and make it more of a mixed day and find opportunity. And in fact, 1,200 stocks out of 3,000 in the New York Stock Exchange were up today, but the bond market didn't allow for it. Treasury yields got so compressed, the yield curve got so flat after the ISM number, and you're pricing in a global stall of some type. So it wasn't really a washout in stocks, but it was just this relentless repricing for perhaps a China recession of some sort and a macro stall, and really trying to force the Fed's hand here, it seems, to get more dovish. One final point, if this is all the market made of those really oversold conditions after Christmas Eve, you have a little bit of an issue. Now, you have a little bit of a 4% buffer in there, but really you should have gotten a little more oomph out of it, or maybe from here on out, you have to see the market respond a little better.
Who'd have thunk it, though, that you would get this kind of announcement, Steph, from Apple? You'd been hoping for a better earnings picture coming into this year. It was one of your key parts of your thesis. I'm wondering if you're rethinking it now based on what we heard.
Well, so for the past year, we've been worried about tariffs and the implications to the economic growth as well as to earnings growth. And in the last 24 hours, we're starting to see it play out in ways that are a little surprising. I mean, look, Apple's announcement, there's a lot going on with Apple, company-specific wise, right? But clearly they did see the tariff impact in China having some sort of an issue for them. But then it was the ISM number. If you dig deep into the ISM number, 1/2 of those people that were interviewed in the survey said it was tariff-related in terms of the slowdown. So now it's really starting to bubble up. We're going to have to see over the next couple of weeks what happens in terms of earnings pre-announcements, and I'm sure there's going to be more. Maybe not to the extent of Apple, but I'm sure there's going to be more.
How does it reshape, if at all, Alli, your expectation for 2019 growth and earnings?
Yeah, look, it's not been a happy new year so far, right? And we're really at the point where if something happens anywhere, it matters everywhere. And I think Stephanie's point is a really good one. We are sort of at hold until we start to see what comes out of 2018 third quarter announcements, but even more what companies are thinking about 2019 and moving forward, especially banks. So this was the beginning of that cycle. But look, I think there are three things out here, and the Apple announcement today feeds into all of them. There are three things that have existed since February, really, that took us into October, November, and December, which are really out there. It's a very unorthodox administration that last year policy helped immensely in the tax repatriation and tax package, and this year we're starting to see the really negative implications priced in on the company side. So that's one. The second is people want to see, and maybe we'll get some more tomorrow, is sensitivity that the Fed is looking at the financial conditions and is going to make decisions based on that. It seems that we do think that if the market is pricing in 0 rate hikes for this year. UBS is still at 2. Now let's see what the next couple of weeks bring. The third thing is global growth, and this feeds hugely into that China story. And China is the largest part of that global growth story. So we still don't have any clarity on any of those three things, and those are the three things that have been weighing on markets for almost a year now. Yeah,
Chinese economic slowdown concerns spooking investors, as you know. Earlier today, Council of Economic Advisors Chair Kevin Hassett addressed this very issue, how it impacts the markets.
I speak regularly with people at Wall Street, and this is something that people have been seeing coming for a good long while. Yes, the Chinese economy is slowing, and one of the reasons why markets are responding the way they are is that people are downgrading their earnings forecast for folks who have a lot of business in China.
Look, we know that weaker earnings were priced in to some extent to stocks, one of the reasons why they have come down a lot, right? I don't think the market was pricing in really ugly earnings. Apple upsets the whole picture, or maybe on where you were thinking the numbers were going to be.
Yeah, but Apple has company-specific issues.
But it's not just, part of my point is that what Hassett went on to say, and he said it specifically, it's not just going to be Apple. Any big company with exposure into China is going to be taking their profit numbers down.
It shouldn't really be that surprising, though. We've already heard from Federal Express. We've already heard from LVMH. We've already heard from Tiffany. We've already heard from Starbucks. All of them have said the same thing that Apple was saying in terms of China, the economic slowdown. Not to mention tariffs, but their economy. Their economy has been slowing since the beginning of last year.
So why were Boeing and
deeper than
Caterpillar
we
down
thought.
4% each today?
Well, that's a complete China play. If you want to buy the China-themed story, Cat and Boeing are kind of the companies that are the ones you would own. And I just think, actually, they've actually held up fairly well in light of what's going on. They're down substantially, but from last year. But I still think that they could have collapsed today, and they didn't. And oh, by the way, what I thought was also interesting today: energy and financials, relative outperformers, not absolute outperformers, relative outperformers, and that's in the last couple of weeks. That's actually been what we've been seeing.
The fear is that the floodgates open now, though, right? That there's, for every Apple now, there's going to be
Yes, absolutely.
1, 2, 3, 4, 5 large companies that are coming out and cutting guidance.
Yeah, no, I think exactly. I mean, I think people are thinking about, look, this has been a sentiment and negative momentum-driven market for months now. And that has been that's based on just sort of prognostications of the future. Now we actually have more than a prognostication. We have evidence that some of these fears are warranted, maybe not warranted to the extent they are. But again, as Stephanie said, it is not news that China is slowing down, right? And we have seen every Fed in the past adapt to these conditions in the economy. So I'm sort of overwhelmed by the negativity that we've seen in this year so far, because even coming into this year, we already had priced into the market a 10% earnings decrease, right? And you had an ISM number again that there are some issues embedded in it, but it was down. Yes, it was less good, but it was still a solid number based on a solid economy.
I feel like we're dancing around the issue, Mike. Is the market expecting a recession or not?
The market is pricing in a higher probability of recession for sure,
well, the bond
and that it's a lot closer.
Bond market.
Absolutely, it's a lot closer than basically people were positioned for, than assets were priced for. If you do look at the bond market, I mean, the 10-year yield is almost below the 1 year. Now, people generally look at the 2 and 10. So right now, the bond market is pricing in a relatively high probability that there's going to be a cut before very long in rates by the Fed. Certainly a higher probability than there'll be an increase.
Yeah,
we heard from the Fed a few weeks ago
could be a
that there are 2 more
premature
hikes this year.
panic. I know, you're absolutely right. But that's what the bond market is. I mean, it was a little bit of a buying panic there. I do think the sentiment toward China is much more pronounced in a negative way right now than it is the company by company, what's the impact, right? It's about the president kind of tweeting in a celebratory way that the tariffs are bringing in billions of dollars right now, which is this kind of flawed analysis of how they work, but that doesn't really say, hey, really rushing for a deal by March 1st. So the idea that aggression toward China on trade is somehow part of the plan, and the pain in China is part of the plan, that doesn't sit well to a vulnerable market, even though I don't think it necessarily is telling you how it's going to turn out.
You and I